All right, let's talk about a huge tax myth that trips up so many people. Form 21-6. We're talking about deducting your job expenses. A lot of us think we can still write off things like mileage or that home office setup, but the reality is, for most W-2 employees, that's just not true anymore. Let's get into why.
So let me ask you something. Do you drive your personal car for your W-2 job? I bet a lot of you do. Maybe you're visiting clients, running to the post office, or bouncing between different work sites. For years, that meant a pretty nice tax deduction. Well, I'm here to tell you, things have changed. A lot.
Okay, let's just rip the Band-Aid off right now. For the tax years running from 2018 all the way through 2025, the vast majority of W-2 employees simply cannot deduct their unreimbursed job expenses. It's been suspended. So if you've been claiming those costs, you need to listen up because it's absolutely critical you understand why that has to stop.
So what happened? Where did this deduction go? It kind of feels like one day it was here, and the next, poof, it just vanished for almost everyone. Let's unpack the law that made this happen.
The culprit here is a piece of legislation called the Tax Cuts and Jobs Act, or TCJA. Before 2018, the door was wide open for W-2 employees to deduct these costs. Then, bam! The TCJA came along and basically slammed that door shut, suspending that whole category of deductions from 2018 through 2025. Now, what happens after 2025? Well, that's the million-dollar question, isn't it?
And just so we're crystal clear on what we're talking about, it's all the stuff you'd expect. The mileage you put on your personal car for work, the software, office supplies you buy yourself, those professional memberships you pay for, even tools and equipment for your job. For most of us W-2 folks, all of it gone from your federal tax return, at least for now.
Okay, so I said the door was slammed shut, but it's not completely locked and bolted. There are a few, and I mean a few, very specific exceptions. A tiny group of taxpayers who still have a key, this chosen few who can actually still use Form 2106.
I want you to really picture this. There's a locked door. 99% of us can't get in. But there are exactly 4 groups of people who are given a special key. And let me tell you, you have to fit the description for one of these groups perfectly. There's zero wiggle room here. First up are Armed Forces Reservists. But here's the catch, and it's a big one. You have to be traveling more than 100 miles from your home for your duties. What's great about this, though, is that it's an above-the-line deduction. In plain English, that means you can take it even if you don't itemize your deductions. That's a nice perk.
Okay, next we have qualified performing artists. And you've got to listen to how incredibly strict these rules are. You need to have at least 2 employers in the performing arts, your expenses have to be more than 10% of your income, and here it is, the real kicker, your adjusted gross income has to be $16,000 or less. Yeah, $16,000. That makes this a very narrow exception.
The third key is for a group that's a little obscure, fee-basis state or local government officials. This isn't your typical government employee getting a regular paycheck. Instead, these officials get paid based on fees for the services they perform. It's a pretty uncommon setup, but it's one of the 4 exceptions.
And the final key, number 4, is for employees with impairment-related work expenses. This is so important. We're talking about costs that are absolutely necessary for an employee with a disability to be able to do their job, things like attendant care at the workplace. These expenses are still deductible as an itemized deduction on Schedule A.
Now, because so many people don't know these rules have changed, there are some major traps that well-meaning people fall into every single year, and these mistakes can lead to errors, audits, and some nasty penalties. So let's cover the big ones.
The biggest trap of all is commuting. The IRS could not be more blunt about this. Your drive from your home to your main job is never deductible. It doesn't matter if your commute is 5 miles or 500 miles. It doesn't matter if you're on work calls the entire time. To the IRS, it's a personal expense, period. End of story.
So you have got to know the difference. Commuting, home to your main workplace, is a no-go, non-deductible. Business travel, like going from your office to a client's office or to a temporary work site, that's different. But, and this is a huge but, even that is only potentially deductible for one of those chosen few we just talked about. For everyone else, it's a moot point.
All right, this next one is a huge warning. I call it the software trap. You know how it is, you're using tax software, trying to do everything right, and a little box pops up and asks, did you have any job-related expenses? It seems so innocent, so helpful. But it's a trap. It creates this false hope. If you're not in one of those 4 specific groups and you start entering your mileage, the software might generate a Form 2106 you don't qualify for. And that is a massive red flag to the IRS, basically an invitation for an audit.
Okay, so you're probably thinking, great, so I can't deduct anything, I just have to eat all these costs? No, not at all. The smartest play here has nothing to do with taxes or deductions. It's about shifting your focus to something much better, getting your employer to reimburse you. Now, how your employer pays you back is everything. There's a right way and a wrong way. The right way is called an accountable plan. This is the golden ticket. You submit proof of your expenses, they pay you back, and that money is 100% tax-free. It doesn't even show up as wages. The other way is a non-accountable plan. Here, they give you the money, but it gets added to your W-2 as taxable wages, so you get paid back only to turn around and pay taxes on it. Ouch.
So here's your game plan. It's just 3 simple steps. First, talk to your employer. Go to HR or your manager and ask the magic question. Do we have an accountable plan for reimbursements? Second, you need to keep meticulous, bulletproof records. We're talking detailed logs, every single receipt. This isn't for a tax deduction anymore, it's to get your own money back. And third, actually submit those expenses for reimbursement. This is the correct and completely tax-free way to handle it.
And this all leads to the big cliffhanger. This whole law is temporary. It's set to expire after 2025. Will the old deduction come back? Will we get something new? Who knows what Congress will do? But honestly, it almost doesn't matter. The single best strategy, right now and for whatever happens next, is having perfect records. It's your asset defense, it's how you get reimbursed today, and how you protect yourself tomorrow. So the real question I want to leave you with is this: are your records strong enough for whatever's coming next?